Several times in recent weeks, we've taken the time out to look at the interplay of Chinese monetary numbers with the real economy and with financial markets there. And we'll make no real apology for doing this once more and revisiting it. We've had another month's worth of data. Therefore, we can see whether some of the trends we were talking about earlier have continued in the fashion that we thought they might. And also, we've had time to consider different aspects of this problem and to try to work in some new illustrations of why we think that though an immediate crisis is probably too strong an interpretation to put on things, certainly the sea room, the leeway for the continued performance of the Chinese economy in the manner which we have seen over the last year or so, and perhaps arguably over the past 6 or 7, is just beginning to run out. And so now that Xi Jinping has overcome his first primary hurdle of securing power for himself and his clique at the Chinese People's Congress, perhaps we might see some developments going forward that change the picture somewhat.
So to recap on something we've commented about before, if you notice on this slide we had M1 growth, which last year grew very rapidly, accelerated up to over 20% year on year, and has since decelerated equally rapidly. We're now growing at a rate half a standard deviation below. This is the most violent deceleration we've seen in 5.5 years. And the actual level of M1 now compared to this 2015 trend is 2.5 sigmas down. So dramatic slowing in transactional type accounts. M2, of course, is even worse. If we look at M2, we've been bleeding away now for 4 or 5 years. The rate of growth is the slowest we have had in the modern record, stretching back to the start of the century. And the disparities, both in terms of the rate of growth and the stock compared to the previous trend, only gets ever bigger. And it's not just on bank balance sheets that we have a problem, it's also off them. If we look at the rate of bond emissions, taking 12-month increments, again, we can see that we've gone from a period of record high growth up here last year to the slowest rate basically since the rebound from the crisis back here in 2008-9. The pace of growth has slowed to barely 5% a year now, and the increment has changed so dramatically that whereas we were doing 3.9 trillion yuan every 12 months last year, we're now only doing 900. So effectively there is 250 billion less yuan per month being issued in the bond market. And because of this inability, or the suppression, the discouragement of use of shadow financing, so-called, banks have stepped into the gap. And what we can see from this chart is if we look at the turquoise line here in the background, which is loan growth, you can see the sudden acceleration at the beginning of this year. What has happened here in the last 9 months is that the rate of addition of loans is 20% higher than it was last year. But now we'll look at the area here in the columns, which is the contemporary 12-month running M1 growth, and you can see this has fallen away dramatically. In fact, it's diminished by 40%. So loans up 20%, deposits down 40%, and M2 deposits down 15%. This is a gap, this is a wedge being driven across bank balance sheets between the asset and liability side, which cannot grow forever. And just to try to illustrate the extreme nature of what's going on at the moment, we have here plotted the rate of growth of loans against M2 deposits, which of course are very highly correlated. And we've taken the residuals here in red, and you can see they've gone off the chart, 2.5 standard deviations away from their trend. And the rate of climb away from that trend is also one of the most extreme on record. Remember the wedge? The wedge is driving in hard and fast into bank balance sheet. Now, whether or not it is mandatory, whether it's an actual regulation or not, it is good banking practice not to loan out every single dollar of deposits. Loans tend to be longer term, at least some of those deposits are short term withdrawable, the rest are easily broken. And in China, it's been the case that for a number of years, whether by the fiat of the central bank or not, the loan to deposit ratio has supposed to be around 75% or in fact lower. And what we can see here is this wedge that we're talking about again has translated in the last year from a 12-month increment of loans at 80% of the increment of deposits to one which is now remarkably over 100%. So remember, this is a rolling 12-month increment, so the overall ratio of the stock is still below 100%, but the marginal addition is higher, and therefore the overall ratio is inexorably being pushed up. And just for reference, not strictly as relevant as this, but if we look at the rate of TSF growth over the last 12 months, total social finance, compared to deposits, we've shot here from around about 1-for-1 all the way up to 145. So we're adding 50% more in credit exposure across the whole system than we are getting back in deposits. Now, if you'll permit me to briefly interrupt this presentation in order to add a quick commercial. I can offer a great deal of help and assistance with your work, whether it is bespoke research, whether it's my routine background research into macro and markets, whether it's with your marketing material, your end of month presentations, your client presentations, whether it's actually presenting and talking to your clients. Give me a call, send me a mail. I'll be happy to discuss with you the terms and conditions of my services. Thank you. Now, to quickly recap, we've talked about this before. There is, of course, a good degree of co-movement between changes in the money supply and the price per square meter of real estate sales in China. And again, you can see here that the deceleration in money in red in the last year has, of course, brought with it a deceleration in the price of real estate. We know there have been all sorts of other measures here and all sorts of other policy issues which are not strictly monetary, but nonetheless the two are interlinked. And if we actually take the levels here, real estate growth per square meter was over 10% last year. Now it's under 4%. And as you can see, again, that's a multi-year low. And where this is really starting to bite is in commercial real estate, and specifically in office real estate. Again, you can see the good degree of co-movement. There's a few odd examples here where perhaps things haven't quite gone that manner. But again, look, here's the deceleration in money supply, here's the deceleration in office prices. And this time we've gone from year-on-year growth of over 20% to a year-on-year decline in price per square foot of 8% or so. That can only be increasing pressure on the commercial real estate giants themselves and, of course, eventually their bank lenders. Looking at the wider economy, we do know and we are well aware of the fact that perhaps the Chinese GDP numbers are the most suspect and possibly the least well compiled of all. Not to say that we don't have problems with the similar vast over aggregate that measure represents in other economies, but nonetheless, if we do plot nominal GDP and or the implied GDP deflator against changes in money supply, we again get a good degree of co-movement. And what we have done here, in fact, is we have taken the second difference, the change in the rate. I believe the new phrase is the credit impulse, although here we actually have a money impulse. And you can see again that when the red money supply goes up, GDP and prices tend to quickly respond, and vice versa when it decelerates. And here we've had one of the fastest accelerations in money growth, in fact the fastest barring the reflation itself after the Lehman crisis and the snowball earth episode, which ground everything to a halt. We've now had a deceleration of a kind, again, not seen really since the back reaction from that, and we've just begun to see GDP and the deflator, the momentum in their movement, not the rate of growth itself, but the increase in the rate of growth roll over. What one suspects, of course, that's going to happen is that this is going to head down. Now, what we can see here is that whereas 2 years ago, when perhaps the foreign exchange loss was starting to bite on money creation in China, GDP was slowing down. We then got the deliberate acceleration, assisted by a good deal of special lending and repo programs from the Chinese central bank, which took M1 back 4-5% above its trend rate, and GDP began to respond. M1 has now decelerated back to trend. GDP, we suspect from the previous chart, will not get anywhere near its previous trend. And what should be of even greater concern is the mix. That nominal GDP now is increasingly being made up, not of responses in the real growth rate, but in prices. So as real GDP barely edges off its century-to-date lows against the trend, we see prices, however, have responded very dramatically and gone from the worst levels since the crash, the most subpar rate of growth since the crash, back to trend. So all that work that the monetary impulse did in re-accelerating and reinvigorating NGDP growth, nominal GDP growth, has gone mostly into prices and not into real output. And as a way of trying to visualize this picture, what we've done here is we have taken the percentage of change in NGDP growth which has come from prices alone. And you can see that in the past year, prices have been responsible for 35% or more of the overall change. So more than one third of NGDP growth is simply price change, and that's the highest level for over 6 years yet again, and is of course towards the top of the overall range that we've seen this century. And if we now look at the change of what happened a year ago to here, which is what this second graph shows, you can see that the second derivative is pretty much the same level. It's almost 30%, almost a third, and that has only been exceeded in the modern era in the Great Reflation, in the immediate impulse there to get things back from the crash, and it goes all the way back to the early 2000s. The data here are, of course, even more suspect than they are up here, so we don't really know whether that's higher or lower. But nonetheless, the percentage of NGDP growth, which is not real growth, but which is simple price inflation, is the highest level in 6 years. It's increasing, that proportion is increasing at one of the fastest levels on record. This suggests that even if the Chinese central bank, the Chinese authorities, manage to reinvigorate deposit growth, thereby stave off a contraction in bank credit extension, and possibly also supplement the moves outside of the banking system in the bond market, it looks as though they're going to get more bad news in terms of higher prices, faster inflation as generally understood, and less purchase on what's happening in the real economy. Not a very pretty place to be. To put all of this in the widest possible context, and using figures that the BIS compiles up until the first quarter of this year, we can see that in the period since 2011, which effectively was the end of the big reflation after the GFC, China has added nearly 80% to its debt to GDP ratio. It's added over $4 in debt for every dollar in extra GDP. The States, which we all worry about so much, has added $2.50, but that has scaled to the point that there is no net addition in the debt to GDP ratio. The Eurozone's gone up about 12%, Japan 20%, and the other EMs 32%, which is a brisk enough pace if we're honest about it. So now it's no wonder perhaps that we have had someone from the central bank talking about the Minsky moment in China. In other words, that there comes a point where all this extra debt creation is the problem, not the solution. We know that nothing was going to be done about this until Xi Jinping had consolidated his grip on power at the Party Congress, but that is now behind us. As ever with China, we need to see whether firm words and good intentions translate into action, and whether that action persists once the inevitable side effects make themselves manifest. But what we do know is that there is less and less room for business as usual.